Hello, and welcome to the May 2025 Market Economic Update, hosted by Kingdom Focus Financial in conjunction with Chuck, Michael, and myself. We're here to give you this month's news of what we're looking at and what we're thinking about here as far as what's happening.
Thanks, Derek, and it's a pleasure. Thank you guys for joining us online today. I hope that you're transitioning into spring. Well, can you believe it? We're here already. Temperatures where I'm at in Pennsylvania are warming up, and it's short sleeve weather already, and I'm kind of enjoying that. On the flip side, people probably haven't been enjoying what's happened in the market over the past several weeks. So even it might be really good that it's nice outside, and maybe that's keeping you from jumping on and watching your portfolios every day. As we're walking through a normal cycle, you've been hearing in our recent videos, we were expecting to walk through some type of a compression in the market given the last 2 years. This is not new information. But this month, we want to take a pause again and dive in and just give you a little bit more reassurance that we are walking through a normal cycle. And Chuck, I'm going to let you kind of lead the way here. I know you've worked hard and put together some statistics and things that I think are super relevant to share with our listeners. And welcome. Good to have you joining us as always. Take it away.
Hey, thank you, Michael and Derek. And boy, this is going to be a good one, guys. I'm sure we got many sports fans here on our recording. And I want to harken back to something that Vince Lombardi said, and I'm going to tell a little bit of a story here and intertwine it with going back to the basics, how important foundational principles are when we're going through times of peril. So here's the story, gents. Back in 1960, Michael, your Philadelphia Eagles actually beat the Green Bay Packers in the 1960 NFL Championship before the Super Bowl era. And the Packers blew a fourth quarter lead, as the story goes. So we get into 1961, the first day of training camp following that loss. And the seasoned veterans and the Packers were wondering, what's Coach Lombardi going to talk about? Is he going to talk about how we blew the fourth quarter lead? We need to get back to execution. He did anything but that. He held a football in his hand, put it up in the air and said, gentlemen, this is a football. And he got back to the basics of tackling, carrying the ball without fumbling, and how you throw a pass properly, how you catch it. And I thought that was great because there are foundational principles that all of us, when we first started to invest, learned. We kind of take those for granted, especially when we go through times of peril. So I'm going to rattle off a couple of these guys and interject at any point in time if you'd like to. So going back to 1980, principle number one, 45 years of data. We all know the good news, the average rate of return, if you were fully invested in stocks, the S&P 500, is about 10.6%. Here's what we forget. The average intra-year peak to trough drop is 14.1%. So what does that mean? Every single calendar year, we should train ourselves to believe that we're going to have an intra-year drop inside our stock portfolio of roughly 15%. Now, why have we been lulled to sleep? The last couple of years, especially 24, 2023, 2021, even the COVID year in 2019 prior to that, we had very benign losses. If you actually look at for the last 6 years, they were less than 10% intra-year losses, I should say. So that's principle number one. Principle number two, and I hear this all the time, Michael and Derek, and it's kind of one of these pet peeves. When you invest in the stock market, it's analogous to gambling. It isn't. When you gamble, and it's not one of the things that I do, I'm not very good at it. And part of the reason I don't do it or not very good at it is because the odds are in their favor. You are the house in this endeavor, and people don't realize that if you actually go over a 5-year rolling period, and you go all the way back to 1950, so 75 years of data, the rolling 5-year deepest drop is 2% in a stock portfolio. It's the same for bonds. And you stretch that over the long term. Go back and read Jeremy Siegel's 1994 classic, Stocks for the Long Term. You will see the longer you hold equities, the less likely you are to have a rolling loss over that period. stretch it out 5, stretch it out 10, stretch it out 20 years.
And I think,
go ahead, please.
Chuck, I want to just with that, I mean, the slide shows that, right? It shows just how in 1 year, right, a lot can happen. But for those who have been working with us, they're familiar. We break things into different tiers: short-term, intermediate, long-term, and really their investing bucket is that long-term focus. And so what I hear you saying is stick to the game plan, right?
Absolutely.
And this is kind of walking according to what the market's doing its thing, right? Do what you do. And that's what the market's doing. And we just do what we do, which is stick with the consistent long-term game plan that's in place.
Yeah, we like to call it stick to the knitting, and go back to harken back to Coach Lombardi. Ladies and gentlemen, this is a football. And I should have said that after the first two. How about slide 4, concept 4, maybe is what I should say. And I love this because, as you all knew, I grew up in Pennsylvania, and we have that classic PA turnpike that spreads the state from basically east to west. And you pay a toll, right? A hefty toll, last time I've been on it, to actually drive over that highway system. I'd like to think of volatility, Michael and Derek, as the toll that we pay to invest. So just take a step back and think about this. A 3% sell-off in a given calendar year. Now, this is going back to 1928, guys. This is nearly 100 years. 7.2 times a 3% sell-off happens. A 5%, which you could call a mild correction, I like to call it a pullback, happens about 3.5 times. Again, that 10% correction on average happens 1.1. Let's go out a little further, a 15%, a little more of a severe correction every 2 years. And here's the one, Michael, you mention all the time, the bear market, the 20% or greater happens once every 3.5 years. Again, we tend to forget those key principles of investing and what we actually signed up for when we began that endeavor, for many of us, several years and even decades ago. Here's one that I know that is near and dear to Derek's heart, because you've spoken to this one. Missing the best 10 days can devastate or crush returns. I think, Derek, you've said, and I really drew into your comment about, you got to be able to predict the correct manner of the equity markets twice when you attempt to do that. So let's kind of use the most recent period, right? We had President Trump and Liberation Day on April 2nd. It happened, his comments, after the close of market on April 2nd. We saw April 3rd, the market begin to sell off. And since that April 3rd date, we kind of had about a 10% sell-off. But here's what people tend to forget. On April 9th, when they actually had another Rose Garden meeting, they said, okay, we're going to give a 90-day reprieve. Equity prices jumped in 1 day, guys, 10%. That's what you miss out on. You had to get out on April 3rd. You said, this doesn't feel good to me, but then know something on April 9th. That's impossible. I think as the slide shows, guys, go back to the year 2008, 38% was the calendar year sell-off. But if you missed the 10 best days, even in that down year, you were down 67%, which is certainly nearly double what the calendar year was down. So let's get to the next principle. Again, this is the Jeremy Siegel, and I love this, and actually Warren Buffett too. It's not timing the market, it's time in the market. Think about this. The daily probability, going back again to 1950, so 75 years of data, equity positive days are 53%. It's almost a 50-50 endeavor if you were a day trader. You closed your book at the end of each day, but you stretch out weekly, monthly, yearly, 5 years, it's 80% positive on a rolling 5-year basis. That's not gambling. You are the house, right? The odds are in your favor, and then you go out to 10 years. I think the break-even point is 13 years. You can actually see the rest of these. So,
Derek,
go ahead, Derek, please.
On this one, just to put it into some specific terms, I know, and the projections that we do with folks looking at retirement and planning that, that fits in well. I mean, we talk about keeping that short-term volatility timetable in more conservative fixed income pieces. You see that playing out in planning?
Absolutely. And the opportunity that affords us is when we are in a drop like this, we can shift our portfolio mix around. So we can move from fixed income, more conservative pieces to buy low when the market's in a dip like this. And then we come back even stronger than before, even if the market just comes back to neutral from where it is.
Yeah.
And that's what we do behind the scenes in managing the portfolios.
Great point, Derek. Why don't we end on two concepts, guys, if you're okay with this, and we'll kind of shift to this toxic mix of emotion intertwined with an investment discipline process, because the two don't mix. They're almost like oil and water. So I'm a member, guys, of what's called the American Association of Individual Investors. And these are kind of the do-it-yourselfers, the ones that think they don't need a financial advisor. Now I have a financial advisor, just want to disclose that. But I subscribe to their data so I can get access to their weekly survey. It's called the Investor Sentiment Survey. And you're asked one question as a member. And by the way, I think the member dues are like $79.99. They're not that much. But the reason I mention this is because I want access to this data. So what's this data? They ask one question to their members. Ma'am, sir, do you believe over the next 6 months the markets will be positive, flat, or negative? And they call that either bullish, neutral, or bearish. Following the Liberation Day on April 2nd, the bearish percentage got to 61.9%. And I asked myself, I said, has it ever been this bad before? Meaning people's pessimism levels. And we did a chart. And the chart actually said, if you go back to 1971, there have been only 7 times when that particular bearish indicator got above 60. And I wanted to know, well, what happens over the next 12 months? Of course, nothing's guaranteed. But this is fascinating, guys. Next 12 months, the average rate of return is 27.92% positive, never a negative period. The weakest was 15.22%. Now, what is this? This is your classic contrarian indicator. It really goes into the psychology of Warren Buffett. When people get fearful, I get greedy, not greedy in an evil or a sinful sense, but in an opportunistic sense. The next one is the University of Michigan Consumer Sentiment Index. 50.8 was the most recent reading. The second worst on record going back to 1971. So what's the Consumer Sentiment Index? Real quickly, it's put out by the University of Michigan. They ask questions not necessarily about investing, but just about everyday habits. Things like, hey, do you have a job? Do you anticipate a raise? Do you anticipate to get laid off? Are you going to buy a big ticket item? Are you actually going to go on a vacation, spend more or less money? They quantify this data into a rolled up number between 40 and 120. The average is 84. We're at 50.8. So here's what we did, guys. We went to the 9 bottoms, which have happened over the last 55 years, going back to 1971. And we calculated from the period when people were most pessimistic going out over the next 12 months, and the rate of return is 24.1. But what happens when the opposite occurs? When people are a Boolean or the most optimistic, the next 12 months, the average rate of return is 3.9%. So what this says is when you have a vicious news cycle that is every single headline almost as negative, people have to train themselves to say to themselves, you know what, the institutional investor, they know this. And they want the retail investor to quit, to capitulate. And when they do, almost like sharks circling around a prey, when they sniff blood, they will pounce in and harp on what people have done. They've sold great businesses at a discount. And it's really kind of sad.
Yeah. And they continue to gather into their own pen. Right. And so the old adage, rich get richer, we actually help them by panicking and not sticking to our plan. So
very well said, Michael.
Excellent information. Chuck, Derek, thanks again for being here. For all of you watching, I hope this was helpful for you as you digest what's been going on in the current markets. And in our theme for this month, I want to do our own little survey of you that are watching. And if this was helpful, why don't you vote by clicking on that subscribe button there on our channel and follow us for more details. And if you really liked it, share it with your friends or family or colleagues who may be worrying right now about what's going on in their own portfolios. You could make a positive difference by sharing the details and the facts with them in their lives. You could bring some peace and calm. We hope that this has brought some peace to you, brought some good information. And as always, we thank you for the trust that you've put in us as your advisors. Give us a call if you have any specific questions, and we'll see you next time. Have a great day.